What's good, guys? Welcome back to another video. On today's video I'm going to be sharing with you on how I personally approach the CRT method, known as candle range theory. So the CRT focuses on one candle, so that's the strategy that I'm going to be showing you. It has different models, and I'm going to post those models on the screen, somewhere on the screen. So but on today's video I'm going to be showing you on how I approach and interpret the candle range theory using just one candle. And I promise you guys, this strategy is easy. The only problem is that people make it seem complicated on the internet because there's too much information. So I promise you guys, at the end of this video you are going to understand everything clearly and you're going to be profitable. That's what I'm going to say. So let's get into the charts. Okay guys, so we're going to be focusing on CRT. Okay, so CRT, which is the candle range theory. So as I said before, we are going to focus on one candlestick. So with this strategy, guys, the direction of the market doesn't matter, but it is more powerful when it's in a line with the direction of the market. So what you want to do is first go to the daily time frame. So on the daily time frame, you are going to focus on one candle, which is the previous day candle. Meaning what? Let's say today is a Tuesday, right? So we are going to focus on the Monday candle. So maybe the candle is going to be something like this. This is the Monday candle. So today is a Tuesday. So when you go to the daily time frame and you mark the daily candle. So what do you mark? What you want to mark is you want to mark your highest point on the candle and your lowest point on the candle. So what this means is, on this one candle, when you drop down to the lower time frames, this high and this low acts as a turning point or a liquidity point for the lower time frames. This is where the market usually bounces off. So the reason being we want to trade this theory is because we want to trade when the market sweeps this low or sweeps this high. So when the market sweeps this low, our expectation is that the market is going to go to the nearest liquidity point, which is the highest point. But obviously we don't trade on the daily time frame. We only trade on the 15 minutes, 5 minutes, or even the hour time frame. It's fine. So after marking your high and your low on your daily time frame, you wait for a sweep. So a sweep is going to be something like, it's going to be a candle and a wick. So this second candle, you are still on the daily time frame, remember. So this candle is supposed to close somewhere here, but since we are trading using the one candle method, you are not going to wait for this candle to close. You are going to trade this candle without closing. If we were focusing on a different model, we're going to wait for this candle to close on the inside. But at this point, we are not focusing on that, which is why we, after the market sweeps, we want to take this candle, hoping that it takes us here. Because after analyzing and following our rules, all we can do is just wait and hope that the market hits our TP. So this is what we are looking for. But then, how do you find a trade? So this is where you go to smaller time frames like the 1 hour. Like the 1 hour time frame. So the market, you will have your high that you have marked and you will have your low that you have marked, right? So our expectation is that the market is supposed to be something like this. So since the market swept on the low, that means the market was doing this. The market swept the low, and how do we find an entry? The only way we find an entry is we wait for a market structure shift and a fair value gap here, and wait for a market to pull back, and we long from here, targeting the next liquidity point. But the market most of the time reaches this liquidity point it's about 50-50 that the market reaches 100%. So what you want to do, I will show you on the charts. What you want to do is always target the 50%. The market is likely to hit the 50% before it even reverses. But let's say you don't want to trade on the 1 hour time frame. You can always dive into the 15-minute time frame. It's the same thing. It's basically the same thing. The 1 hour and the 15 minutes will give you one thing. Sometimes the 1 hour doesn't give you a fair value gap, but the 15 minutes can give you a fair value gap. Okay, sorry about that, guys. We're running out of storage, but then let us continue with the most important thing. So, just to reframe your mind again, or to rephrase your mind, we start on the daily time frame. The market direction doesn't matter, or the daily bias doesn't matter. The market can be either bullish or bearish. Or one thing I forgot to mention, we do not trade the strategy on a consolidating market. No strategy trades on a consolidating markets unless you are a support and resistance trade. So we start on the daily. You mark the previous high and the previous low of the candle of the previous daily candle, and you wait for a sweep. You dive into the 1 hour time frame, which will look something like this, and then you wait for what a market structure shift. So a market structure shift is when, guys, let's say we are bullish, just like we did here. We were bullish, right? So when we were bullish, the market started hitting a higher lows and a higher highs. Okay, I mean lower lows and lower highs. Sorry for that, lower lows and lower highs. So when the market comes at the bottom to retest on this fair value gap, you don't just enter on that fair value gap. The reason being, the market is going to do this, give us a pullback, like it's going to do something like this, give us a pullback, and leave this lower high here, which we want the market to take out first and leave a fair value gap somewhere around about here, and then the market comes down to give us a retest on that fair value gap, and that is when we enter. Some will tell you it's a head and shoulder strategy. Why? Because this low is a shoulder, and this low is a head, and this low is a shoulder. It's something like a head and shoulder strategy, if you understand. So this thing, guys, is really simple. You don't need to overcomplicate it. It's only three time frames. If you don't want to use three time frames, you can use two time frames. But the 15 minutes works well when there's no fair value gap on the 1 hour. Sometimes we find the fair value gap on the 15 minutes. But if there's no market structure shift, but there's a fair value gap, do not enter the trade. Do not enter the trade. Sometimes the market does a market structure shift and does not have a fair value gap. If there's no fair value gap, but then you see something like an order block, you can still enter the trade. But if there's a market structure shift, no fair value gap, it's impossible that the market doesn't have an order block. There's always an order block. But then there's also an invalid order block. You do not enter. You do not enter. So these things need to align. So the three rules of this strategy is: you wait for a sweep, you wait for a market structure shift, you wait for a fair value gap. If those three align, it's 100% guaranteed that you are going to hit that 50%. But your chances of hitting this 100% are likely, they are small. But the market may, hence I said at the beginning of the video, the market may hit the 100% only if the strategy aligns with the daily bias. If the market is bullish and we are also trading bullish, the market may hit you 100%. So what you want to do is maybe have about four orders. Two orders, you close them at the 50%, and then you move your stop loss to break even. So now, guys, since I think you all understand this, we are going to dive into uh, the market and focus on real technical analysis, guys. So this strategy is not overcomplicated. So now, for now, let's dive into the chart, and I will show you real life examples. Uh okay, guys. Okay, guys. So this is one of the examples that I wanted to show you guys. So as you can see on this trade, I caught this trade last week. Uh, what I want to show you is that there's no fair value gap here. Some will say this is a fair value gap, but then there's no fair value gap. So I'm going to remove this and go back into the daily time frame just to show you guys how I caught this trade. Just to show you how I caught this trade. So you can clearly see we're on the daily time frame, and this candlestick, I marked this candlestick on Thursday, the 5th of March. So as you can see, we had a sweep towards the upside, and when we have a sweep on the upside, we want to sell the markets. But then when we have a sweep on the downside, we want to buy the market, right? So we had a sweep on the upside, and the candle closed inside this range. So as you can see, we already know that we want to sell. Okay, so we don't just sell on the daily time frame. This is where I dive into the 1 hour time frame. And when I come into the 1 hour time frame, one of the most important things that I'm looking for is a fair value gap or an order block. But in this stage, there's neither of them. Okay, there's neither of them. So what do? I dive into the 15 minutes. Just like I said before, if the market doesn't give you a fair value gap on the 1 hour time frame, maybe it may give you a fair value gap on the 15-minute time frame. But then at this stage, there's no market structure shift on the 1 hour. But then I just found the market structure shift where on the 15-minute time frame. This is a market structure shift. So I'm going to market structure shift. Then, just like I said before, most of you will think this is a fair value gap, but to me this is not a strong fair value gap. This is not a strong fair value gap, because look at this fair value gap, guys, as you can see. So what I want to do is I want to mark this as an order block. Okay, I want to mark this as an order block instead of marking it as a what's this, as a fair value gap. So how did I catch that trade? So just because okay, there's an order block, one of the things that I do is to take my Fibonacci and just put it just there where the reversal started to happen, and put it right here. So as you can see, guys, this golden zone told me this is where I should sell the market, and this is where I had entered. Put my stop loss, whether you want to put the stop loss here, but what I normally do is put my stop loss right above that order block, or if there's a fair value gap, right above the fair value gap or below the fair value gap, depending on the direction of the market. So this is where you target. Now obviously I can't just target to the downside or the next liquidity point just like that. As you can see, this is a 1 to 10 risk to reward ratio. So what do? You come here to the side. As you can see, you take this ruler, you measure your 50%. You don't measure here and there. So you measure these points that you have marked on your daily time frame. So you measure that candle, but now you're measuring it on the 15-minute time frame. So now what I do is, you can see this arrow is a 50%. So I take my horizontal ray line and I put it right about here. So as you can see, this low acted as my take profits, or the next liquidity point. So this was my liquidity point number one. Some will want to target this lows here as their liquidity point, but for me this 50% is my liquidity point. And you can see you can catch about 1:5 risk to reward ratio. As you can see, guys, it was a clean entry, no reversal, nothing. It was a clean entry. So you can see that, guys, you can make a lot of money just by targeting the 50%. But then for me, targeting the 100% is okay, because my emotions and everything are just in the right state. I'm in the right state of mind of being able to hold trades like this. But then what do you do when the market hits your 50%? Obviously you don't just let the market run. You close. Okay, you don't just close. Your TP is already here. If you trade without using TP and stop loss, then you're just gambling. Your TP is already here. Let's say you have about 4 orders. You close 2 orders, and the remaining 2 orders you move your stop loss to somewhere around about 1:3. Yeah, somewhere around about 1:3. Why? It's a break-even trade. So even if the market reverses without hitting that 100%, you know that you are safe. You know that you are safe. So guys, this was the trade that I caught. Now I'm going to give you a real life analysis. Okay, what am I doing in the weekly? So I'm going to give you a real life analysis. So what I told you before was, you go to the previous daily high, you mark out the high, and you mark out the low. So after marking them out, you can see that there's no sweep, meaning the market is still consolidating inside that range. So the market may play around about here before sweeping. The market may just play. So what we want the market to do, want the market to sweep and create a market structure shift, leave a fair value gap for us, and we enter our trade. So what you don't do, guys, you don't say the market is going to sweep and then go up, sweep again, and then now you want to enter. It doesn't work like that. The strategy doesn't work like that. So in simple word, what the strategy is, it's accumulation, manipulation, and distribution. That's what the strategy is: accumulation, manipulation, distribution. So let me give you an example. So this is manipulation, right? This is manipulation. So we're waiting for price to sweep either the high or the low of the market. So now let's say the market sweeps the low. So the market accumulated, now it's manipulating, and then we wait for what? We wait for a distribution of the market. So this range, hence I said before, you do not trade a consolidating market. So this range right about here is consolidating, and then this range here is manipulation, because a lot of people would think the market broke out, came back to retest, and then now the market is going down. And then this is where we want to enter, because we do understand how the market moves. So we want to enter here on the distribution and target the resting liquidity. Target the resting liquidity. So this is how the strategy should be: accumulation, manipulation, distribution. And there's no two rules for this strategy. So let's say on your recent price there's no fair value gap, but then you can see an inverse fair value gap. It will still work. It will still work as your confirmation, because an inverse fair value gap will have something like a previous support area. Will have something like a previous support area, as you can see right here. This was a liquidity point where the market was bouncing off. So this was a liquidity area. So the market was clearing liquidity, and then you're going to have an inverse fair value gap roundabouts here. So you can enter even though there's no fair value gap on the recent price. So this is how the strategy should be. So let me see if I can find you a trade. Let me see if I can find you a trade. So, and remember guys, if the market sweeps on both directions, that means there is no trade. That means there is no trade. So as you can see on the USD Swiss franc, we already have a sweep. And it's a beautiful sweep, guys. So remember, there's no 100% trading strategy. You just have to follow your rules and stick to one model, guys. Okay, I made a mistake here. It was the 1 hour time frame. Okay, there's no sweep. So we move on to another trade. Let's look at the next 100. Do we have a sweep? No, we don't have a sweep. Why? Because the body is outside the previous daily candle. And then when we use this previous daily candle, okay, this was Friday's candle, we can clearly see that there's no sweep. And then we move on to the Monday candle. You can clearly see that the market is sweeping, but then with the way the market is moving, we can't call this a sweep, because you can see that the market is clearly trying to break this candle. So with the market trying to break this candle, we just have to wait. It may happen that the market closes inside. If it closes inside, then we may enter a trade, but for now we just move on and try to find another trade. Okay, so this is SMC. It's nothing related to the strategy I'm teaching you. So let me see on USD CAD. Okay, yeah, this is the trade that guys I had found just today on USD CAD. So let me reanalyze this trade for you and show you why I'm seeing buys on USD CAD and why I'm seeing buys. So I'm going to mark out this candle. This candle closed on Friday last week, so I'm going to mark out the high and mark out the low of the candle. So now I'm mixing, guys. I'm not just using the one candle that I taught you to use. So you can just copy what I'm doing and just apply it to your strategy. So as you can see, the market swept this candle. After sweeping this candle, we're now looking to long this position, but we don't long on the daily time frame. So we just go to the 1 hour time frame and look for a market structure shift and a fair value gap. But do we have those things? Yes, we do. So here's our fair value gap right here. This is our fair value gap. Where's our market structure shift? You can clearly see the market structure shift. I don't even have to mark it for you, but then I will. This is our market structure shift, and then we just label it, and we are just waiting for the trade to come back to us. But then if the market hits our stop loss, then it is what it is, and then we target that 100%. We put our stop loss right about on the fair value gap. So I'm going to, yeah, let me do this. So where's our 50%? We take the ruler, we measure our 50%, and then we do this. So this is how the trade should look like, guys. So I think this is enough. Yeah, if you did not understand anything, guys, please feel free to tell me on what I missed or on what you don't understand. comment down below, and please don't forget to like, share and subscribe. So yeah, this is the current trade. If you see this video today and it happens that you want to trade, you can also take the same trade that I'm going to trade. So yeah, I'll catch you guys on the next video. Hey. Yay!